This week's number, 31. That's the number of Abrams tanks the U.S. is sending to Ukraine. History teaches us appeasement does not work. The best way to end a war is to win it. Welcome to Prof G Markets. Today, we're discussing Tesla's earnings, Chevron's share buybacks, and Elliott's activist stake in Salesforce. Here with the news is Prof G media analyst Ed Elson. Ed, what is going on?
I was just talking to our producers, Scott, and they told me that you've come up with this new business strategy. So apparently, if we want to beat CNBC, Prof G media employees need to become, quote, more freaky.
That's right.
Could you elaborate on that?
Well, okay, so I'm serious about this, and this is what you want to do. All strategy comes down to answering one question: what can we do that is really, really hard? Right? We want to find something we can do well that is really hard for other people. And what I think about is I think of CNBC as not as much our competition, but an aspirational goal. I actually like CNBC. I learn a lot there. Mm-hmm. But they sort of have what I would call almost a monopoly on business media as it relates to at least television. And I think podcasts will ultimately migrate upstream and have video, although I don't look good in a sleeveless dress. Actually, I look pretty good. I shouldn't say that. I look pretty good. But anyways, why don't the women on CNBC get sleeves? Anyway, but what we want to do is we want to go places that CNBC can't. And what can we do? We can be more honest and more transparent and more educational. That's not the business they're in.
I like that.
We can be more crisp. They've got to fill 12 or 14 hours of programming a day, which means if you watch CNBC long enough, you're going to have people come on and contradict someone exactly 3 hours before that. They have to be somewhat sanitized or starch, and that is, I like it when we're offbeat, off color, provocative, crazy. So I have tasked the team. We want to go where CNBC can't go. So we want to do things like, I think the idea at the end of the show, we should do karaoke to an 80s song, whatever it is. But people enjoy.
Apparently you said you want us to start drinking on the job. Do you stand by that?
That's probably a dangerous thing to have on tape. But
it's a strange managerial decision, but we could do it.
The bottom line is, my charge to you and the rest of the team is we need to let our freak flag fly.
Mm-hmm. Well, if any of our listeners have any ideas for how I can become more of a freak, let us know. I guess let us know in the comments.
All right, get to the news.
Let's start with our weekly review of market vitals. The S&P 500 climbed on reassuring economic data. The dollar was stable. Bitcoin reached above 23,000. I'm shocked by that. And the yield on 10-year treasuries fell. Shifting to the headlines. The US economy grew at a higher than expected 2.9% rate for the fourth quarter as measured by GDP. That's still a slowdown from the third quarter's 3.2% rate, and year-over-year growth was just 1%. The Department of Justice filed an antitrust lawsuit against Google, alleging it's abusing its dominance over digital advertising. If it goes through, Google could be forced to sell parts of its ad business, which accounts for roughly 80% of its revenue. Hindenburg Research, which famously exposed and shorted the fraudulent car company Nikola, we had an unpack about that a few months ago, Hindenburg has shorted Adani Group, accusing the conglomerate of stock manipulation and accounting fraud. Almost immediately, Adani's companies lost $12 billion in market value. And finally, Ken Griffin's Citadel posted a record $16 billion in profit for 2022. That makes Citadel the best performing hedge fund in history in terms of overall net gains. And for context, this year the top 20 hedge funds posted $22.4 billion in profits combined. Scott, do you have any thoughts here?
Well, one is, one of our predictions was that the U.S. would reassert its dominance. And if you look at our economy right now, we sort of have the Goldilocks economy, and that is we're growing again and inflation is coming down. So that's not easy to do. That is, threading the needle. So Jerome Powell for Times Person of the Year The DOJ's antitrust suit against Google, I hope it goes through. I feel like it's Groundhog Decade. We've been talking about this forever. I think what's going on at Hindenburg Research, kind of calling out some of these companies and doing the work and saying this doesn't make any sense. I think it's capitalism at its best, where someone gets economic motivation to, basically call a spade a spade. I love this stuff. I think it's really interesting. I think the most interesting story, or the one that's not getting the attention it deserves, is that Ken Griffin's Citadel, $16 billion in profit in 2022, a year that I would bet the majority of alternative investment funds lost money. 2022 was, I think, the 8th worst year for the market on record. And I was on with Anderson Cooper last night talking about ChatGPT and AI. And what strikes me is that the most profitable artificial intelligence firm in history so far is, in fact, Citadel. Because if you look at Citadel's competitive advantage, what they do, I mean, what is AI? AI at the end of the day is a computer that does something that traditionally has required some sort of human intervention. And then if you take it one step further, the current applications of AI are around prediction models, or some sort of language machine that guesses the next word. So when I ask it, what color is the night sky? It has absorbed so many data sets that it knows that the next word should be dark or black. And it's not thinking, but it's scanning all these other data sets. And the advanced areas, it can look at unstructured data sets and make sense of them and start absorbing them and learning from them. But what Citadel has done is they've taken 200 plus disparate data sets, whether it's LinkedIn data or Robinhood trading data, and they feed it into an algorithm, and they have a data scientist that says, all right, when traders or investors at Robinhood, who are retail investors, are buying this way at this volume across this type of stock, it usually indicates that the stock is about to do X, and they can trade against that or create alpha there. And they have a massive number of inputs, and they have speed. They've built all sorts of models and all sorts of infrastructure. And I think it's effectively their predictive models, or their AI, if you will, that has resulted in a hedge fund that has had unparalleled performance. So I think of, quite frankly, Citadel is the most successful AI company in history to date. And I wonder if the advances in AI are going to democratize it, and you're going to see sort of a leveling of the playing field, if you will. But anyways, Citadel, artificial intelligence company.
Yeah, it's so interesting because when I was reading these headlines, they were reporting that Citadel is the greatest hedge fund ever. And I'd always thought of Citadel as a market maker. I didn't think of it as a hedge fund. And then as I looked into it, what they're actually saying is the hedge fund arm of Citadel is what has returned $16 billion in profit for 2022. The market making operation is a completely different business. And then the other thing that's crazy is how much this benefits Ken Griffin, because Ken Griffin owns 80% of that company. And, we talk about, Bezos and Elon and their net worth going up by 5 to 10 billion at swings at a time. Ken Griffin, if he owns 80% of the company and he's taking let's just call it a 20% carry of that 16, he made $3 billion in cash last year, which no one else is doing. So my takeaway from this is bravo, Ken Griffin.
Yeah, I mean, supposedly, fun factor, apparently a 19-year-old Griffin had various short positions in 1987, right before Black Monday, using money he received from his grandmother. So there's just no doubt about it. This is an impressive trader, investor, what have you. There's even talk that he might be getting into politics, which would be pretty interesting. But yeah, and as many of these individuals do, and it's sort of kind of represents this great migration. If you look at migration patterns in the United States, they're effectively two things. They're sunshine and low taxes. And that is high tax cold states, whether it's Illinois or Massachusetts or New York, are losing people. And Florida and Texas, sunshine and low taxes are getting people. And along those lines, Ken Griffin famously moved from, I think he was living in Chicago and is now in Miami. But it's happening. It's happening everywhere. I did it in 2011. So I set the trend there. And obviously, Ken is following my lead. Anyways.
All right, let's move on to our first story. Tesla reported record revenue and record profit in fourth quarter earnings last week. Revenue came in at $24 billion, that's up 37% from the year before. And profit was $3.7 billion, that's up 59% from last year. These results are coming after the company cut prices to stoke demand in January, and now, according to Elon Musk, Tesla is, quote, seeing orders at almost twice the rate of production. Tesla shares rose 5% in after-hours trading, but the stock is still down 48% from a year ago. Scott, one of your predictions for 2023 was that Tesla would post record revenue, check, but also that Tesla's stock would get cut in half. You made that prediction in November. It's down around 15% from then. It was down more before, but it's sort of bounced back in the last month or so. Do you still believe that your prediction is going to come true?
Yeah, so at one point it was down 45%. I thought, wow, I got that right fast, but now it's ripped back. Tesla reported record quarterly revenues, operating income, net income, and full-year car deliveries, 1.3 million cars versus 936,000 cars in 2021. I think that's about a 35% increase. It also beat on the bottom line, $1.19 versus $1.13, and it beat on the top line, 24.3 billion versus 24.2 expected. The only troublesome numbers, and this is a great earnings report, you got to give the company its due. The only thing that was not ideal was the gross margins on the car are at 24% versus 26% expected, and that's a function of them lowering prices. That's just simple competitive pressure. There's just more cars to choose from. They needed to move cars off the lot. I think it was the first time they ever actually had to offer discounts, but their margins are now off 10% from 27% in Q4 of 2021 down to 24%. And I think that's going to be one way. I don't think they're going to recover as there's more and more competition. But the revenues year on year are up 51%. That's incredible. Net income, almost 14 billion, which is doubled. And keep in mind, they only went profitable in 2020. So in the last 12 months, Tesla is earning more profits than General Motors, which is just striking. And it's a function of its brand, and it's more of a software company. People would argue than a manufacturing company. So those margins are especially impressive. So growth plus better margins equals just better market capitalization and better EBITDA. So look, you have to give the company its due. It did really well here. If I had read the earnings report, I wouldn't have known whether the stock was going to go up or down. There's just a general belief in the market, I think, right now that Tesla went down too far, and it's got positive rebound momentum right now. I would argue that something we do as investors that is not a good idea is that we anchor off of history, and that is you got to look at a stock where it's trading right now, and where it has been really doesn't make a lot of difference over the long term. And if you look at Tesla right now, if you look at its multiples, you look at its multiple on revenues, its multiple on earnings, it's just still trading at just an enormous premium to the rest of the market. Yeah, true, it's been cut in half, but it's still crazy expensive. If you're
let me just take us through the multiples right now. Mercedes, so compared to all the other car companies, price to earnings ratio for Mercedes 5.6, Ford 5.7, Renault 7.7, Honda 8.2, Tesla is 44.6 price to earnings ratio. So it's still crazy high.
Yeah, and it deserves a premium. The question is, does it deserve 5x the premium? And I think the answer is no. So again, I'm sticking to this prediction. As F. Scott Fitzgerald said, intelligence is the ability to hold two contrary thoughts in your mind at the same time. This company will continue to perform really well, record deliveries, record revenues, record top and bottom line, and its stock will decline, in my view, dramatically. I still think it's overvalued.
So some separate news to the earnings. Last week, Tesla delivered 15 semi-trucks to Pepsi. And this is something that Tesla shareholders have been waiting forever for. It's the first big delivery. And one of the big questions you were addressing is something that everyone's asking. Is this a car company or is it something more? And I think the Tesla bulls would point to this and say, no, Tesla's going to take over the trucking industry and the transportation industry. Heavy-duty trucking is a $200 billion market. This is so much more than a car company. Do you think this is enough evidence to say, okay, we can value this differently to other legacy car companies?
The honest answer is I don't know. But this is basically an autonomous driving play, I would think, because if there's one place that autonomous driving makes a ton of sense, and Jason Stavers, our editor in chief, pointed this out, it's in long haul trucking. Driving around a city, getting to and from work in an urban area, you can see how that requires so many cameras and has so many risks and dangers, whether it's hitting other cars or other people. But if you can put a a self-driving semi on the road at 3 in the morning, and it drives between 3 and 8 in the morning across long haul interstates, you would think the technology is probably there. In addition, it's a shitty job. Some people I used to enjoy commuting. When I lived in LA, I had a 28-minute commute to work and I liked it. And that was enough, to listen to my favorite Tom Petty album or my mixtape on my cassette that my girlfriend had made me. But I enjoyed it. I don't think long haul trucking is a good job, and it feels like something that feels like the first place autonomous driving will go. Tesla has invested a great deal of money in autonomous driving. However, having said that, autonomous driving is definitely one of those technologies where the performance has not kept pace with the promise, and that is, it is taking much longer than we'd anticipated. And I love the quote from Bill Gates. I think he made it 10 or 20 years ago. He said, technology that's supposed to take 10 years oftentimes takes 3, and the technology that's supposed to take 3 years often takes 10. And I thought that was really interesting. And I would argue that autonomous driving is the latter. It was supposed to be here just in 2018, 2019. We were supposedly on the cusp of millions of self-driving cars, and it hasn't happened. So it feels to me like it's 5 or 6 years off, and that the promise of a Tesla truck was to say to these organizations, you're going to dramatically reduce costs and increase utilization. I mean, Elon Musk is such a great salesperson. He says, and he has this great metric, he says that once a car is self-driving, it becomes 10 to 20 times more productive. And that makes sense, right? I have a Tesla, I park it, I turn on a switch, and I can rent it out while I'm sleeping. Okay, go get people or transport stuff for people or whatever, or go pick up someone from the airport and just start making money or monetizing the asset while I'm in my sleep. It's a really compelling thought. The first place should be in long-haul trucking. It doesn't appear to be happening as fast as we'd hoped.
And then finally, something we mentioned are these price cuts. So Tesla prices came down around 20% in January. And I think it's important to mention here that with that discount, 2 of their cars, the Model 3 and the Model Y, both of them are now going to be eligible for the Inflation Reduction Act tax credit. And what that basically says is that under a certain price, which they've reached, you get $7,500 off covered by the government. And to me, what this doing here is just trying to make Teslas super affordable. And in the past, Tesla has been very much a luxury brand, but it feels like maybe they're pivoting away from that. So do you have any insights into the branding side of this? Do you think that this is a good idea, that they're trying to make Tesla more affordable? They're taking advantage of these tax credits, but they're probably going to lose this luxury footing that they've had since their inception.
I don't think so. I think they can pull this off. And it's exciting just from a societal standpoint. The problem with EVs is they were just too expensive. And the bulk of the market, I mean, the real 80% of the market just couldn't, maybe 90% of the market of auto buyers just couldn't afford an EV. They were just too expensive. And the ones that were priced at a reasonable number were just shitty cars. Remember the Leaf or whatever it was called? So I think this is great to inspire more EVs. They can pull it off. BMW has a 3 Series. It's not an inexpensive car, but companies go up and down the food chain. There's the A4, the A6. Generally, cars are going to kind of have 3 models, like good, better, best, and then they have a general positioning. And they're built on the same platforms. It's a business of scale. If you buy a Q7 from Audi, you're also buying a Porsche Cayenne, and you're also buying a Volkswagen Touareg. They're all built on the same platform. They just have different finishes. But within each model range, even at the luxury range, they usually have the 3 Series, the 5 Series, and the 7 Series. That's BMW. So kind of going up and down the food chain, they're still not inexpensive cars, but I think they can still maintain that luxury positioning. It's still an expensive car. They still offer $140,000, I think it is, Falcon X. So yeah, they can pull this off.
Okay. Bullish on the business, bearish on the stock. Makes sense. Let's move on to our second story. Energy giant Chevron is planning a $75 billion stock buyback after it registered record profits in 2022. The company will also increase its dividend payouts, and this program will launch in early April. Chevron's current market cap is $350 billion, which means that this program is worth almost a quarter of the company's total value. Chevron shares rose 4% on the news. So, Scott, let's start with a more basic question here. What is a stock buyback, and why do companies do it?
It's a way of returning capital to shareholders. So it's basically a company says, we are a profitable company, we have positive cash flow, we end up with $1 billion in cash at the end of the year. And we don't have an immediate plan or growth strategy where we could deploy with a decent ROI hurdle that $1 billion. So we go out and with that $1 billion, we buy our own shares back and we reduce the number of shares from, say, 100 million to 90 million outstanding, meaning if we do, $1 billion in profits, instead of having a $10 EPS, we have an $11 EPS, which should take the price of shares up, which is sort of a tax-efficient way, if you will, of returning capital to shareholders. If it was a dividend, they'd get taxed. This way, they're ideally or theoretically, the value of their shares goes up, and if they don't sell them, they're growing the value of their shares in a tax-deferred manner. Now, oftentimes, share buybacks, some people call it financial engineering. Some people would accuse management of lacking vision when they don't put capital to work, and also because management is largely compensated based on the value of shares, because the majority of their compensation, sometimes 90, 95, 98% of their compensation comes from options tied to the stock price, that it's reduced the creativity of CEOs to reinvest in the economy, that they would rather just go take all of their excess capital and do share buybacks, thereby juicing in the short term the stock price and increasing their compensation. And that's sometimes not the best thing for the economy because a small number of people own the majority of shares in companies. And would that capital be better spent, if you will, or be better for the economy, better for the Commonwealth, if people or companies were motivated to build new factories, hire more people, try and innovate more in R&D? So it makes sense, and I believe there's legislation that's passed that has said that there will be greater taxes on share buybacks. Also, Ed, what is really ugly is when companies, specifically airlines who did this, take all of their excess cash, buy back stock, juicing the stock price. The CEOs of these companies make $150 million in compensation the 3 years before these companies all pre-pandemic, and then go hat in hand to government saying we need a bailout because why? We don't have any cash because we use it to buy back stock. And what do you know? I made a shit ton of money, but now we're all in this together. And what this creates is a situation where we're capitalists on the way up and then socialists on the way down looking for bailouts. In a company or an economy where you have capitalism and private capture on the way up, the government bailouts on the way down, that's neither socialist nor capitalist. It's cronyist, and it's wrong. So I think any company that's had a certain level of share buybacks shouldn't be eligible for government bailouts. Go out of business. Delta should have gone bankrupt.
Yeah.
Anyways, share buybacks, it's like anything. They make sense to a point.
So you mentioned these bailouts, specifically in terms of airlines, but oil and gas took bailouts too. 2 years ago, during COVID, the government gave the oil and gas industry $10 billion in tax cuts and loans. And so it just feels crazy to me that now, 2 years later, all these companies are seeing record profits now. Chevron apparently has $75 billion to play with. And their response isn't to, reinvest that capital back into the business, which would help them survive another macro incident or maybe help them move faster towards sustainable energy. No, instead their response is, we're going to cash out shareholders with dividends, and we're also going to pump up the stock price with buybacks. So isn't this just really financially irresponsible and on a higher level just wrong?
To a point, because a mature company, companies don't grow forever. At some point, they've kind of, I don't want to say maximized their position, but they're profitable. They're doing what they're supposed to be doing. They're aggregating cash. And to tell them to mandate that they spend all of their cash again on growth means they're going to make probably a lot of dumb decisions. So a certain level of stock buybacks kind of makes sense. And also, sometimes you're just taking the shares back to where they were a few years previous because you will have to issue additional shares for compensation of management.
Right.
So the natural pool of shares increases on its own.
Right.
So share buybacks can sometimes just take the total share count back to where it was just a few years ago. But when you're just optimized for share repurchases and you're not seeing investment, you're not seeing, and you're seeing a lot of, what I'll call compensation without investment. It's a tough one. I think the government landed in the right place, and that is, okay, you're not going to make this illegal, you're not going to inhibit it, but you're going to tax it. And that is all right. It would be great if you spent that money on a new factory or more employees. If you don't, fine, but you're going to give us some money such that we can have more capital to spend on social services and investments that the government might make.
And then next time they come back to the government and say, can we have a bailout? The government says no. Is that your position as well?
I generally don't think we should have bailouts.
Yeah.
I think the bailouts of the financial institutions in 2008 of $600 or $700 billion kind of made sense, and they gave up, I think, preferred stock, and the government got most of the money back. You would argue it was a successful bailout, but bailing out airlines, that makes no sense. Airlines have gone bankrupt 62 times since the year 2000. They should absolutely have been allowed to go out of business, and some other guy with a big ego and an idea would have started another airline. Companies should be allowed to fail.
Yeah.
And what we have here is big companies who are well connected in Washington take excessive risk on the way up, knowing that it's moral hazard, knowing they'll be bailed out on the way down. They should be absolutely allowed to go out of business.
Okay, let's move on to our third story. Activist investor Elliott Management has taken a multi-billion-dollar stake in cloud software firm Salesforce. Elliott's strategic position is unclear, but people familiar with the matter say shareholders are concerned that CEO Mark Benioff has become distracted. One of those distractions, they fear, is celebrities. One source said Matthew McConaughey and will.i.am are frequently involved in strategy discussions at the company. Another source said, no, it's just casual business discussions. Either way, they appear to be around. But Elliott hasn't brought up any of these concerns. The only public statement we've seen came from managing partner Jesse Cohn, who said, quote, "We have developed a deep respect for Mark Benioff and what he has built, and we look forward to working constructively with Salesforce." Salesforce shares are down 30% in the past year. Scott, another activist play. This is coming right after our discussion of Nelson Peltz and Disney and their proxy fight. What are your initial reactions to this one?
So this is going to be, you're going to see more activist activity this year than we've seen in a long time. And it's not because management is behaving poorly or they've made bad decisions. It's because the market is down, or a lot of the biggest companies, a lot of the best companies have had their stocks cut by 50%. And Salesforce is right in that sweet spot. It's a great company. It's a cloud company, unbelievable relationships, unbelievable cash flow. And it's got very strong management. Now, they've had some hits. Brett Taylor, co-CEO, left, and people still, I don't think, really understand why. That reflects poorly on Mark and succession strategy. He was a young man and well thought of among the troops. I'm a bit conflicted because I know both Jesse and Mark, and they're both thoughtful, smart people. Does Salesforce probably need to trim some costs? Probably. But we were talking about this off mic. I've been to some, not social events, but quote unquote business events invited by Mark, and will.i.am was there. But I also know Mark well enough to know that he is very focused on business and very bright and exceptionally hardworking, exceptionally committed to the company. So at the end, I think they're both right. But I think that effectively, Elliott's motivation for investing in this company is not what they think Mark has done wrong, but what he's done right. Specifically, it's a great company, and the market's taken it down 50%. And I think what they'll do is, I think they'll just mostly stand by for a year and hope that the market takes it back up again on its own. And if it doesn't, then they'll come in with kind of a finer, scalpel and say, okay, Mark, we would like to see the following 2 or 3 changes. But there's nothing better than being an activist and letting the market just take the stock back up because the company is undervalued. Like Nelson Peltz at Disney, I wonder if anything he wants to do actually happens, but it's going to be a win for him because the stock is down. I was an activist investor at the New York Times. I went and said, you need to cut the dividend, you need to double down on digital, and we need to divest of non-core assets. They did all of those things, and the stock went from 18 to 3. And the reason why was because we went into the great financial recession. And that is market dynamics always trump individual performance. And that's why you always need to diversify, because regardless of how smart you are, regardless of the situation, regardless of how good the company is, the market is bigger than you or the company. And in this instance, I just think the wind is going to be at their back because they're coming into great companies. Many of them, especially I look at Disney. I think Disney is on sale right now. Disney is trading where it was 8 years ago. Unbelievable trove of assets. And these activists, to a certain extent, will give management cloud cover to make some some hard decisions around cost cutting. Sundar Pichai says that TCI, the activists at Google, was not the reason they cut staff. But my guess is they're pretty cognizant of they know what their shareholders want, and it absolutely plays a role. But I think this is going to be a win. I would bet this is a win both for Elliott and Benioff. I think you're going to see the stock recover. Elliott will make a bunch of money, and Mark's company will kind of find its footing again.
What was the nature of that Salesforce event, and what was Will.i.am doing there? Did he speak, or was he just hanging out? I'm fascinated.
No, Mark is a tech guy. Pulls together. He would do Dreamforce, these huge events, and then he would do smaller events. And there'd be some entertainment component, but then he'd want to talk about business, and everyone would go around it. And I've only been to a couple of them, but almost all of them do this. And look, these are humans. If I were a billionaire, I would get a kick out of hanging out with Matthew McConaughey, but they're not dumb. These guys, they're they're not totally naive. I remember I was advising a hedge fund that was hugely successful from 2006 to 2008, and it'll go nameless. But I remember walking into the kitchen one day, or the snack room, and Martin Scorsese was in there. And I'm like, oh, it's Martin Scorsese. And the reason why is that this hedge fund manager had become a billionaire, and his wife had decided that she was a film producer now. Why? Because they had billions of dollars, and they could produce films. And Martin Scorsese was now hanging around the office. And so this is wealthy people have options, and they get access to stuff. And especially in Hollywood, you find a lot of artists who are very drawn to capital, who will finally let them make their art, i.e. a shitty independent film or a critically acclaimed independent film that makes no money. And so you see this a lot. Find me a really wealthy person, and you're usually going to find someone that's hanging out with athletes or movie stars, and good for them. It's fun. But I don't think, at least at Salesforce, I didn't see anything that felt like a threat to shareholders.
Just to push back, though, I mean, Salesforce down 30% on the year. They were in the bottom 10th of the S&P 500 last year. The CEO left. They had 2 other executives leave. They're laying off 10% of the workforce. They're probably going to lay off more. Don't you think even being seen with these people, even the idea of having fun and hanging out with Matthew McConaughey, when you're a public company CEO, you just have an obligation when times are tough to not look like you're having fun? I mean, it's such easy bait for people to say, he's distracted, he doesn't know what he's doing, he's just trying to have a good time.
I think what you're saying is there's a lot of veracity to what you're saying. I think that optics are important, and people will put up with that stuff when the stock's going up. They won't put up with it when the stock's going down. And, my guess is Mark's going to do less of those dinners, fewer of those dinners. Whether it'll have any tangible impact on the stock or whether it did, I don't know, or the business. But I think you're right. I think the optics matter. And the one thing that activists always want when a stock is down is focus. And they don't want to see distractions, whether it's non-core businesses, whether it's buying a social media platform or whether it's hanging out with celebs or whether it's investing in health projects to cure death or dirigibles that will help uh, uh, deliver broadband to emerging markets. I mean, Facebook was doing all sorts of crazy shit. The the one thing they always say is they're always like focus. And my guess is that the conversations, I just know both of these guys. They're both really smart, reasonable people. I don't think this is gonna end up in a proxy fight. I don't see that happening here.
Yeah. See, I was having doubts about whether Elliott actually trusts Benioff as the CEO. But from what I'm gathering, you think that they probably do.
Well, I don't know, but then the question also becomes:
Yeah.
does Mark Benioff want to be CEO for much longer? Mark is,
Right.
what is left for Mark to accomplish? He might say, "Okay, I want to get this thing back on its footing," but he's sort of checked
Yeah.
every professional box in history. Worked at Oracle, started a
Yeah.
competitor, and built one of the most valuable companies in the world, and arguably one of the two or three most valuable cloud companies in history, and is worth, I don't know, what's he worth, 30 or $50 billion. So he's probably, I don't think he would mind the idea of a succession strategy. It just all comes down to the individual. You have Rupert Murdoch trying to recombine his two companies at the age of 92. But, Mark, I don't know Mark well, but I know him, and he strikes me as a very kind of self actualized guy that really enjoys life. And I wouldn't be surprised if he says, look, I'm going to get this back on its feet. I'm going to name a successor, and we're kind of off to the next generation of Salesforce.
And final comment. You were mentioning that you think this is going to be sort of the year of the activist. What do you think Elliott is going to do here? What activist positions are they going to take? I mean, to me, it's maybe just more layoffs. But what could they do to tighten the belt?
Well, activists generally want one of a few things. They want a change in strategy. They want to say, okay, you're going after the wrong market. If Meta had one class of stock, an activist would have been in there a year ago and said, just stop this bullshit metaverse, shut down Reality Labs, and the stock doubles. That would have been the easiest activist play in the world. But an activist can't do that because Mark Zuckerberg is in charge and he can ignore any shareholder because he owns the voting shares there. Generally, they want to change in strategy. They want to change in management. So when Dan Loeb went into Yahoo, there was a CEO there for a hot minute who exaggerated his resume. I thought it was bullshit that he got kicked out for that. He said he was a computer science major when he wasn't. Who the fuck cares? So they want to change in management, or they want a disposition of assets. It's sometimes they say go acquire stuff, but usually what they're saying is, okay, you have a core asset in here, you need to spin it or sell it. So there'd be an activist that comes into eBay and says, spin out. I remember talking to Barry Rosenstein, who runs Jana Partners, a really thoughtful guy that is an activist investor. And I pitched him, must have been 15 years ago, on the idea. I said, look, there's an asset that eBay owns that is worth more than eBay, and it's called PayPal. And it was just obvious that if PayPal was liberated from this bidding trading platform called eBay, it would trade at a much higher multiple. At some point, Target used to be owned by a company called Dayton Hudson, which was this old stuffy retailer, and then they spun it out. It's usually a change in strategy, a change in management, or the disposition of assets. But good activists for the first 12 months will usually say, we're here to help. We're going to hang around the hoop. We're not going to come in guns blazing. We're going to try and establish a productive relationship and just see how things go. And what you hope is that the market and management kind of recover on their own. That is the easiest way to make money, is to come in and buy. The most important thing about a successful activist is when they buy in, at what price. Because it's better to be lucky than good, or better to buy a stock at the right point in the cycle than anything you can orchestrate. The primary strategy, if you will, that activists will all be jonesing for or pushing or advocating on their targets will be very simple, and that is cut costs, which is Latin for fire people. And that is, the majority of these companies have amazing businesses, but they have stuffed so many calories down the esophagus of these companies in the form of new hires that there's fat everywhere. And I think what you're going to see is, and it's not aspirational to say it, but I think a lot of these companies could lay off 10, 20, maybe even 30% of their workforce. and those people won't be missed. It won't impact the frontline product, and it won't impact top-line revenues. What it'll impact in a very positive way is the bottom line and the stock price.
So apparently Mark Benioff takes business advice from will.i.am and Matthew McConaughey. But if you wanted celebrity business advice, who would you talk to? Here's Mia on the street.
I'm Mia. We're about to hit the streets of Williamsburg to ask people if they would take business advice from celebrities.
Absolutely.
Wow, such conviction. Which celebrity?
It'll be Oprah Winfrey.
Mr. Donald Glover. There's a few. I'd probably go with Joe Rogan.
Warren Buffett popped to mind immediately, but like a Kim Kardashian, probably not. Although she has her own business, so maybe so.
I'd honestly take business advice from one of the Kardashians because although there's like nepotism involved, they know what they're doing and they would probably give me good advice.
Well, I mean, Kim Kardashian knows business more than most, so that's one I would listen to if they had something to say.
Kris Jenner, like honestly no, because she's on top of it, or like Yolanda Hadid, like the mothers. Beyonce's mom. What's her name?
Beyonce's mom.
Beyonce's mom. Hey girl, hit me up, Miss Knowles. Like put me on.
What we're looking for, what we're asking for is how to be born into these families. So like baptisms coming our way.
Adoption.
A lot of
looking. Yeah.
Angelina wants more kids. The four of us.
We're a very diverse group. She would love us.
So I would take business advice from one person only, Madonna. I think that she's unhinged and chaotic, and I am also unhinged and chaotic in certain ways. Also, I feel like she's probably somebody who's like a dad type that knows about like stocks and bonds and shit. I don't know why, but I feel like she has that.
Right. We're back. We learned that people will take business advice from celebrities. I think only one person said that they wouldn't. And let's be honest, I probably would too if a celebrity tried to give me business advice. That's it for this week. Till me on the street next week. Signing off.
Okay, let's take a look at the week ahead. We'll see January data on consumer confidence, job openings, quits, and the unemployment rate. And we'll also hear from Fed Chair Jerome Powell. Economists are expecting a 25 basis point interest rate hike. And we've also got a big earnings week. Apple, Amazon, Google, and Meta are reporting. So are Snap, Spotify, Match Group, Peloton, Ford, GM, and Exxon. Scott, do you have any predictions?
My prediction is that when we look back in 12 months on the investment that Satya Nadella and Microsoft made in OpenAI of $1 billion in 2019, we're going to see that as visionary. Everyone's talking about the $10 billion investment now, but the $1 billion investment getting in early is going to be one of the best investments in corporate history, specifically whether or not AI lives up to the hype. It's going to give Microsoft the opportunity to bring new life to something that was already kind of dead and buried, and that is Bing. And I predict that Bing, under the auspices of an AI-driven Bing, whether they call it Bing powered by ChatGPT or Bing AI or whatever they're going to call it, is going to double or triple its market share, and it's going to take a $1.5 trillion stock or company to 1.7 or maybe 2 trillion. And that $10 billion, while it seems a lot, is going to add a few $100 billion in market capitalization to Microsoft. And people are going to correctly, and analysts are going to realize that that early investment in AI was a visionary move by Microsoft and Satya Nadella. That's all for this episode. Our producers are Claire Miller and Jason Stavers. Special thanks to Catherine Dillon, Ed Ellison, Mia Silverio, and the Prof G Media team. If you like what you heard, please follow, download, and subscribe. Thank you for listening to Prof G Markets from the Vox Media Podcast Network. Join us on Wednesday for office hours, and we'll be back with a fresh take on markets every Monday.